Equities and bonds gained in the US yesterday despite less than ideal economic data, while Apple jumped in the after hours trading following a smaller than expected jump in its quarterly revenue and a monstrous share buyback plan. So today, all eyes are on the US jobs data. Many people expect to see a potentially strong reaction to today's jobs figures from the US given the rising uncertainty about the Federal Reserve's easing plans. So welcome to Swissquote's daily market talk. Happy Jobs Friday, guys. So sentiment is not bad for a week where we heard the confirmation that the US Federal Reserve won't be cutting its interest rates anytime soon. But stocks rebounded still and yields fell at yesterday's trading session. The S&P 500 kept floor above the 5,000 psychological mark. Nasdaq 100 jumped 1.30% as the US 2-year yield slipped below the 4.90% level despite economic data showing a bigger than expected jump in the US unit labor costs, combined to a larger fall in productivity over the same period. Factory orders, on the other hand, fell in the month of April, which could have been good news for the Federal Reserve those. But no, because input prices rose and they rose at the highest speed since the 2022 peak in inflation. So my conclusion about the market reaction to all that was that investors just want the stocks to rally even in May and defy the popular saying, sell in May and go away. No one is going nowhere for the moment. And more good news, well, Apple did just fine after the announcement of its mostly feared quarterly results yesterday after the closing bell. Remember that 10% drop in iPhone shipments to China kept investors up at night regarding the first quarter results, but all in all, the sales dropped just 4%, so that's very slightly less than expected by analysts, thanks to a 14% jump that we saw in Apple Store sales, and also earnings grew more than expected by analysts. The company also said that they expect sales to return to growth right away, and more importantly, Apple announced a higher dividend and a 110 billion US dollar worth of its stock buyback, the biggest of its history. As such, the stock price rallied 6% in the after-hours trading, avoiding a road accident at the most feared earnings announcement of the past few years. Now, the company didn't say anything new or anything that we did not know regarding its AI efforts, so we will have to wait until the June 10th to hear more details about their AI plans, and I think that's something that actually could have waited on investor sentiment at the earnings announcement, but the side of that 110 billion US dollar worth of share buyback helped investors swallow the pill, and on May 7, Apple will be revealing the new iPad to eventually get things moving. So price-wise, the post-earnings rally that we will see in Apple could help Apple break above its year-to-date descending channel top sustainably and pave the way for more gains for the company. Also, obviously, on hope to hear something worthy on the AI front in the next few weeks. So the outlook is more positive after the earnings than before. Hence, the US futures are up at the time I'm talking here this morning in the wake of better than expected results from Apple and ahead of today's much expected and much important US jobs data. So the jobs data in the US will be very important this time around, but more than before, probably due to this increased uncertainty regarding the future of the Federal Reserve's monetary policy. So the US economy is expected to have added around 240,000 new non-farm jobs in April. The average pay is expected to have grown slightly slower on a yearly basis, while the unemployment rate in the US is seen steady at the 3.8% level. And hotter than expected data, especially on the wages front, should easily fuel the hawkish Fed expectations and weigh on equity and bond prices before the weekly closing bell. A softer than expected set of data, on the other hand, should give some relief to the Fed those before this week's come to an end. Now, we can't really predict where the markets will be headed after the announcement of the US jobs data, but based on the cost of at-the-money puts and calls expiring today, Citigroup predicts that the S&P 500 could move 1.2% up or down as a reaction to today's US jobs data. That's a big move, and again, it makes sense to have a bigger moves at periods like this of rising uncertainty regarding what the Fed is going to do next. Elsewhere, British FTSE 100 index continues to perform quite well these days. The almost 2% jump in Shell stock's price following over $1 billion profit beat yesterday certainly helped keeping mood in the British blue chip index intact, in fact. So they also announced a $3.5 billion worth of a stock buyback plan. It's not much, yes, compared to Apple's $110 billion share buyback plan, but it is a good number per se. And because Shell makes up to around 9% of the FTSE 100 index, well, a good day for Shell or a good year for Shell is a good day or a good year for the FTSE 100. But zooming out, the FTSE 100 is up by 10% since its January dip. Yes, also because Shell is up by more than 20%. But yes, the UK economy doesn't make anyone dream. We knew that. And indeed, the OECD cut its outlook for the UK economy again and expects it to grow by 0.4%, a meager 0.4% this year. So that's just better than Germany that sits at the bottom of this range with a morose 0.2% growth expected there. But who cares, guys? Who cares? Because Britain's biggest companies will bring the majority, clear majority of their revenues from abroad. So all the British blue chips need is a strong world economy. And happily, well, the OECD now predicts that the world economy will grow more than 3% this year. That's 0.2 percentage points better than their February forecast. And also note that this reflation trade that comes along with the expectation of looser monetary policies across the globe, and that benefits to cyclical names like energy stocks, like mining companies, and financials will continue to play in favor of the British FTSE index. So, if all goes according to the plan, well, the FTSE 100 should do just fine in the coming months. Now, the question is, what could go wrong? Well, inflation. Inflation could go wrong, and that could delay the reflation gains in the British FTSE 100 index. Now, in the FX markets, the US dollar is under a decent selling pressure this morning. The euro dollar is drilling above a minor Fibonacci resistance with risk of seeing gains reverse after today's US jobs report. The dollar yen, on the other hand, continues to retreat thanks to intervention or the speculation regarding an intervention from the Bank of Japan this week that actually helped the Japanese yen rebound around 3% against the greenback since Monday. Now the pair is below the 153 level this morning, and it's clearly the dollar yen's best week since the start of this year. While finally cable tested 200-day moving average to the upside, and the common denominator for what's next in all these currency pairs is the US jobs report. So a strong report could easily reverse gains in major peers against the US dollar, fuel the hawkish Fed expectations, and back a broad-based dollar appreciation before the weekly closing bell, a thing that we hope will not happen. But beyond today's jobs figures from the US, we also hear some bearish voices gather momentum for sterling. JP Morgan, for example, now expects cable to end the second quarter of this year at the 1.22 level. So this is all for this week. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. Follow us on Instagram, on X, and on LinkedIn for regular market updates. Subscribe to our YouTube channel for daily market comments. And please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again next week. And until then, good day trading and have a lovely weekend.